What if I told you the US government is seriously considering a mortgage so long you might still be paying it off while collecting Social Security? And what if I told you there's a scenario where your kids could actually inherit your mortgage instead of your home? President Trump recently shared an image comparing himself to FDR, the president who introduced the 30-year mortgage during the Great Depression. But this time, the idea isn't a 30-year loan, it's a 50-year mortgage. And it's not just an idea. The head of the Federal Housing Finance Agency has publicly confirmed that they're actively exploring it. And the pitch sounds simple: lower monthly payments, housing made affordable. But today, you're going to see why that pitch is one of the oldest psychological traps in finance, and why a 50-year mortgage could quietly reshape the entire housing market. By the end of this video, you'll see the real math no headline shows, the hidden equity problem, and why this would be a good option for certain groups. Let's break it down. To understand why this proposal is such a big deal, we need to quickly revisit where mortgages even came from. Before the 1930s, home loans in America were brutal. Mortgages were 5 to 10 years long, with interest-only payments followed by a massive balloon payment at the end. You didn't slowly pay off your house, you paid rent to the bank and then owed the entire home price at once. When the Great Depression hit, the housing market collapsed. So the government created the modern mortgage, the 30-year fixed loan. For nearly 100 years, it's been the foundation of American homeownership. 90% of buyers choose it, which raises the real question: if the 30-year mortgage works, would 50-year work too? Let's run the numbers using a very real scenario. A $450,000 home, 20% down, $360,000 financed. 30-year mortgage at 6.5%. Monthly payment is $2,275. Total interest is $459,000. Already huge. But now let's look at the 50-year version. 50-year mortgage at 7%, because banks will charge more since it's a riskier, longer loan. Monthly payment is $2,130. Total interest is $879,000. That's nearly $1 million in interest for borrowing $360K. Your reward for signing up for 2 decades of extra debt is a discount of $145 per month. That's it. Probably a month of water bill in exchange for an additional $420,000 in interest. Does that sound like affordability? And it's not even the worst part. The real danger is what happens to your equity. Most people don't understand how mortgages really work. At the beginning of every mortgage, 15-year, 30-year, or 50-year, your payment goes almost entirely toward interest, not principal. Here's the terrifying part. If the market dips or stays flat, or you factor in realtor fees, you could walk away with nothing or even owe money. A 50-year mortgage doesn't help you build wealth, it helps the bank build wealth off you. But there are 2 specific groups who might actually benefit, as long as they understand the trade-offs. Young buyers with rapid income growth ahead. Think of someone in their 20s or early 30s whose income is likely to rise quickly. Tech, engineering, finance, medical residencies, skilled trades. For them, a 50-year mortgage can be a short-term affordability tool, not a lifetime sentence. It helps them qualify today, they plan to pay extra or refinance later, and their future income gives them flexibility. Investors, specifically long-term rental holders. Investors care less about equity and more about cash flow. A 50-year amortization could lower their monthly expenses, increase cash flow, and make rental properties more profitable. This is exactly why you need to be cautious, because what helps investors often inflates prices for everyone else. If 50-year mortgages are bad for homeowners, why are they being pushed? Because almost everyone except the buyer profits. For banks and lenders, they can get 20 extra years of interest payments. For home builders, lower monthly payments equal more approved buyers equal higher home prices. For investors in Wall Street, when home prices go up, mortgage-backed securities generate more interest. For realtors, higher home prices means bigger commissions. Notice the pattern? Everyone in the real estate ecosystem makes more money except you. In my opinion, 50-year mortgages don't solve the affordability crisis. They inflate it. When buyers can afford more through longer loans, sellers raise prices. It happened with cars when 72 to 84-month loans became normal. It happened with college tuition when student loans expanded. More borrowing power equals higher prices. And look overseas. Japan increased mortgage lengths to 50 years, then 70, then 100-year mortgages that pass from parent to child. Is that the future we want? If 50-year mortgages aren't the answer, what is? Here's what actually improves affordability. 1. Build more homes in areas where supplies are low. 2. Let homeowners carry their 3% interest rate to their next home. 3. Update capital gains exclusions, since the 500K exclusion hasn't changed since 1997. 4. Limit institutional investors, since hedge funds shouldn't be competing with families for single-family homes. 5. Expand truly effective first-time buyer programs, down payment assistance, lower rates, and closing cost support. All of these help real Americans. None of them require keeping you in debt until age 80. Here's my key takeaway. Don't fall for the monthly payment illusion. Instead, look at total cost, look at who benefits, and look at your long-term freedom. If this video helped you understand what's at stake, hit the like button, subscribe, and share it with someone who's thinking of buying a home. Thanks for watching, and I'll see you in the next one.